long, Indians have held the view of wealthy as being evil, believing that the rise of the Birlas, Ambanis and Adanis of late is detrimental to their personal interest. We have, as a society, always resented the idea of capitalism, thinking of it as a zero-sum game. While it is not, wealth does trickle down and leave everyone better off. But this isn't the case with crony capitalism, and must be questioned and resented. It refers to capitalism characterized by a close, mutually beneficial relationship of business leaders with the government. Often there exists an extremely thin line of difference between capitalism and crony capitalism, so much so that it is often not much evident to the public eye. But of late, an interesting business case has caught the eyes of the nation. It is that of the meteoric rise of the Adani Group. I'm sure you must have all read the headlines of Mr. Gautam Adani becoming the second richest man in the world, surpassing Jeff Bezos. He has added $65 billion in wealth in 2022 alone, more than any other billionaire around the globe. All this can be attributed to the relentless share price growth of Adani Group companies. In fact, 7 listed companies of the Adani Group account for rupees 10.05 trillion of the rupees 12.74 trillion rise in market cap of BSE listed entities in 2022, around 79%. In the last 10 years, Adani has become the biggest coal importer and miner, private port operator and city gas distribution player. Not to mention, they pretty much make headlines now and then for shopping companies across verticals. Adani Group has been in existence for several years, but it is only since 2014 that they have turned extremely aggressive. One obviously needs a serious amount of funds to afford that kind of rapid growth. From where have they been getting all that money? It's all debt. But no one in their wildest imagination could have thought that a company with such a weak balance sheet and meager profits would have an aggregate of 2.2 lakh crore of outstanding debt, out of which a humongous 1.38 lakh crore is external. Lenders obviously look for security while lending. Doesn't seem secure by any chance, right? Well, there is a very ingenious strategy at play here. If you observe, there was just one Adani Group company that was public in 2008. Today, there are 7. Moreover, the IPOs of these daughter companies gain huge traction among the public due to the Adani tag attached to it, as well as since it makes headlines frequently and remains in public eyes. It is these securities having inflated prices that Adani pledges to raise debt. Thus, in addition to money raised through primary issue, Adani is able to raise debt against shares pledged. Even if we consider a significant margin, that is difference between the market value of a security and the funds lent, a sky-high valuation ensured significant funds raised. There are also several instances of intercompany debt transmission in Adani Group, wherein one company having raised funds lent them to the other company which was struggling to raise them. All this has served them really well in terms of realizing their ambitions up till now. But this may not be the case for long. The thing is that Adani Group is over-leveraged. Recently, a report by credit sites, the research arm of Fitch Ratings, also cited similar concerns, which led to them losing over 94,000 crore in market cap. Even previously, Adani Group has been linked to several Mauritius-based opaque investment funds of having raised undisclosed sums of money. So does this signal the beginning of a new banking fraud? Is Adani Group caught in a serious debt trap situation? Well, there are several reasons to believe so. First, they have been very aggressively expanding into various unrelated businesses spanning various verticals like energy, FMCG, infrastructure, etc., which leads to heightened risks of being unable to repay debt. To add to this, there is little evidence of any equity injections in the company by Mr. Adani to counter the increase in the balance sheet debt, such that the leverage is stable. This leads to a fall in balance sheet strength. In recent years, there have also been several instances of rising competition between Ambani and Adani, with them often using imprudent ways to defeat each other. If you remember, some years down the line, A similar competition existed between Kingfishers and Jet Airways, wherein both of them went on to acquire companies to outplay each other, which actually left them worse off by taking a serious hit on their financials. Even numbers reflect a similar view. If we consider the G spread, that is the interest that a company has to pay to its bondholders over and above what is paid by the government on the bonds issued by them, it is around 250 to 375 basis points, which is among the highest across Indian companies. Also, the mid yield to worst, which is the lowest yield at which the company can call back its bonds, is quite high for Adani Group companies. It also pays a very high interest rate on its outstanding bonds. If we look at the debt to equity ratio of Adani Group, it is at a staggering of 2021%. This is the second worst among all Asian companies. Most of their group companies are trading at a PE ratio which is over 5 to 6 times the industry PE ratio. On a relative basis, this clearly justifies overvaluation, which by no means seems justified. A major concern is that any major economic slump, recession, or even a single abnormal event could actually burst this valuation bubble, which might trigger lenders, banks to sell pledged securities, further driving down the prices. However, there are a few bright spots for the Adani Group. First and foremost, they have a solid relationship with banks and a deep friendship with the government. They have also built strong, sustainable companies which are enjoying huge tailwinds on the back of the infrastructure pushed by the government of India. Additionally, with more of their bonds maturing in 2030s and 2040s, there are no immediate capital repayment issues plaguing the company as of now. Also, a key thing to note is that they have reduced their debt exposure to PSU banks from 55% in 2016 to 21% currently, hinting a more diversified borrowing. So, what do you think? Will Adani's case go down as another banking fiasco in India's history? Or will they continue their meteoric rise unabated? Let us know in the comment section below.